My name is Michael Carter. I'm Managing Director of Carter, Morse & Mathias. We're a 21-year-old investment banking firm, and we raise capital for emerging growth businesses, middle market companies, as well as advise on mergers and acquisitions. Well, in general, the story starts out with easy money leading to a real estate boom, a natural real estate boom, and then a crash, and then how the markets weren't able to withstand that crash. So that's the backdrop, and the pieces will fit into that puzzle, if you will. Traditionally, banks would make a loan, and for the most part, that loan would be made. They would keep it on the bank's books. Sometimes they would sell those loans, but for the most part, the bank had a vested interest in whether that loan was paid back or not. What Wall Street did is they came up with a concept called securitization. Without giving you a sense of what securitization is, it enabled the banks to make loans and then sell them 100% of the loans off. And frankly, it now empowered the banks to make those loans and not take any risk. And so the originator of loans, who was supposed to be underwriting them and watching out for the creditworthiness of the borrower, wasn't connected in a financial sense. They deserve a lot of blame for that. And to some degree, I'll put President Bush and President Clinton in very much the same boat. They both had the same intent here. And the intent is that they wanted to demonstrate to the American people that lower income people were buying homes. And they wanted to take it to about 60% of American households and increase it to 66%. It doesn't sound like a lot, but when you're talking about 100 million households, it makes a huge difference. They encouraged what is now known as Fannie Mae and Freddie Mac, culprit number 3, to guarantee loans that were not as creditworthy as they typically are. And so Fannie Mae and Freddie Mac, when a loan gets made, applies their guarantee, and it's almost like a government guarantee, and all of a sudden it enables those banks to sell those loans very, very easily. And it created a lot of liquidity in the marketplace, and mortgage money flowed into that marketplace. And basically in 1996, Fannie Mae and Freddie Mac guaranteed about 12% of their loans to high-risk borrowers. That number was slowly increased to, that guideline was increased to 20% in 2000, obviously under the Clinton administration, and they did that for good reason. They wanted to encourage home ownership. Fannie Mae and Freddie Mac were making a lot of money, so why not put some of that money toward low-income people? Sounds very good. Again, it's a case of unintended consequences. So clearly what they were doing is they were using government guarantees to be guaranteeing high-risk borrowers loans. And when real estate prices go up, everything's fine, everyone's happy. It's when real estate prices dip that you get into trouble. Now, what's a high-risk borrower? Part of it is income, but part of it is if they're borrowing 90% of the purchase price or 95% of the purchase price, the real estate only has to go down 5% or 10%, and literally they don't own any equity in their home. Most people, when they bought their homes, put down 20%. So they could withstand a 20% shock or decline in value, and it was okay, and everyone kept paying their mortgage. But if I only put 5% down in my home and the real estate values went down 20%, why would I keep paying on my mortgage? With a housing bubble, it basically now was the result, and it was a wonderful result because it's a boom. You called it a bubble, obviously bubbles pop, and that's what happened, but it was a real estate boom. And you had home ownership soaring, you had real estate values doubling from 1997 to 2005, and these are all wonderful things. Fannie Mae and Freddie Mac set up political action committees, frankly with taxpayer monies, and were huge donators to the House of Representatives and senators who served on the banking committees. And Congress put a lot of pressure on Fannie Mae and Freddie Mac to take some of their earnings and take some of their guarantees and move them to lower income people who wouldn't, right? You're helping them. Congress also was influential in creating laws that encourage Fannie Mae and Freddie Mac to enable the mechanics for it all to work perfectly well. When I was on a bank board, we were required to make CRA loans. Those are Community Reinvestment Act. Part of our assets, we had to loan money to low-income borrowers. We typically did in the real estate area because it was easy to prove, and we did that. But we were basically taking taxpayer money and forced to make loans that were high-risk loans. Again, good intentions. These are people that didn't have access to capital, but when you start making capital available to people who are high-risk borrowers, someone's going to have to pay that bill. The regulators were at fault for a number of reasons. Number one, the most heavily regulated institutions are banks. And so they are very, very heavily regulated. However, regulators are notorious for not preventing problems from happening. There's almost every crash, they're sleeping at the switch, and they find out after the fact. And so more regulation wouldn't necessarily have prevented this from happening. You'd like to think it would. It's a nice soundbite. However, what role they do play, and I think it's very, very important, is commercial banks have to keep roughly 10% of their assets in capital. It's their cushion in case something happens. Investment banks, the ones that are now packaging all these securities, are keeping anywhere from 2 to 4% of their assets in capital. Much, much smaller cushion. And so when all of a sudden values started going down, they were underwater very, very quickly. But I think the Lehman Brothers balance sheet grew by $300 billion over the last 5 years or so. Their their equity base grew by only 1% of that, $3 billion. That's extraordinary growth fueled by virtually no cushion. And so regulators could have played a very important role in not allowing that to happen and providing more of a cushion. Obviously they didn't in that case.